Before we dive in, please remember that this video is for informational purposes only. I am not a financial advisor, mortgage lender, or real estate agent. The information provided in this presentation is not a substitute for professional financial advice. Always consult with a qualified professional before making any major financial decisions. The single biggest mistake people make when buying a home isn't the house they choose. It's the loan they get. That one mistake, the one buried in 100 pages of paperwork, can cost you tens, even hundreds of thousands of dollars over your lifetime. Picture this: you find it. The perfect house. The one you've been scrolling past on Zillow for months. It has the backyard for the dog, the kitchen you've always dreamed of, and it's in that perfect school district. You put in an offer, your heart is pounding, and then they accept it. You're ecstatic for about 5 minutes, because then the real journey begins. The mortgage process. Suddenly, you're not a homebuyer. You're an archaeologist digging through mountains of your own financial history. You're drowning in a sea of acronyms: DTI, LTV, PMI, APR. And you're being asked for pay stubs from 6 months ago, bank statements from last year, and what feels like a blood sample. You're terrified of making a wrong move, of getting a bad rate, of signing a 30-year contract that will haunt your bank account forever. Feels confusing, overwhelming, and intentionally complicated. And that feeling is exactly why I created this series. This is your antidote to the chaos. This is your step-by-step, no-nonsense guide to conquering the home loan process in the United States. Over the next 10 parts, we are going to pull back the curtain on the entire system. We will demystify the jargon, expose the hidden traps, and arm you with the knowledge you need to get the best possible loan for your situation. By the end of this series, you will understand exactly what lenders are looking for. You'll know the difference between an FHA, a VA, and a conventional loan, and which one is right for you. You'll learn how to shop for a mortgage, how to negotiate your rate, and how to read that terrifying stack of closing documents. You will walk into a lender's office not with fear, but with confidence, prepared and in control. So where do we start? Most people think the first step is finding a real estate agent or looking at houses. That is absolutely wrong. The first step to buying a house has nothing to do with the house. It has to do with you. Before you can convince a bank to lend you hundreds of thousands of dollars, you have to get your own financial house in order. This is the foundation upon which everything else is built. Get this part right, and the rest of the process becomes 10 times easier. Get it wrong, and you're setting yourself up for rejection and heartbreak. This foundational stage has 3 core pillars: your credit score, your debt-to-income ratio, and your savings. Let's break them down. First, your credit score. This is the magic number. It's the lender's first and most important snapshot of your financial reliability. Think of it as your financial report card. It tells them, based on your past behavior, how likely you are to pay back your debts on time. In the US, this score typically ranges from 300 to 850. The higher the number, the better you look to a lender, and the lower the interest rate they'll offer you. The difference between a 640 score and a 740 score can mean paying an extra $50,000 or $60,000 in interest over the life of a loan. It's a huge deal. So what makes up this score? It's not a mystery. The 2 biggest factors are your payment history and your credit utilization. Payment history is king. It accounts for about 35% of your score. It's simple. Do you pay your bills on time? Every single late payment on a credit card, a car loan, or a student loan can drag your score down. Lenders see a history of late payments as a massive red flag. The second most important factor, at around 30%, is credit utilization. This sounds complicated, but it's easy. It's the amount of credit you're using compared to the total amount of credit you have available. Let's say you have one credit card with a $10,000 limit. If you have a $5,000 balance on it, your utilization is 50%. The golden rule is to keep this number below 30% across all your cards. If it's creeping up to 50, 60, or 80%, lenders get nervous. It looks like you're overextended and relying too much on credit to live. Paying down your credit card balances is one of the fastest ways to give your score a significant boost. The other factors are the length of your credit history. Older accounts are better. Your credit mix, having a variety of credit types like credit cards and installment loans, is good. And new credit, applying for a bunch of new credit cards right before a mortgage is a bad idea. You can check your full credit report for free once a year from each of the 3 major bureaus, Equifax, Experian, and TransUnion, by going to annualcreditreport.com. This is the official government-mandated site. Do this months before you plan to buy. Look for errors and dispute them immediately. Okay, pillar number 2 of your financial foundation, your debt-to-income ratio, or DTI. If your credit score is your report card, your DTI is the ultimate "can I actually afford this?" calculation. It's a percentage that shows how much of your monthly gross income, that's your income before taxes, goes towards paying your monthly debt obligations. The formula is simple. You add up all your monthly debt payments. This includes your rent or current mortgage, car payments, student loans, personal loans, and minimum credit card payments. Then you divide that total by your gross monthly income. For example, let's say your total monthly debts are $2,000, and your gross monthly income is $6,000. You divide 2,000 by 6,000, which gives you 0.33. That means your DTI is 33%. Why does this number matter so much? Because lenders have strict limits. They want to see that you have enough cash flow left over after paying your debts to, live, and to comfortably afford the new mortgage payment you're asking for. Generally, for a conventional loan, lenders want to see a DTI of 43% or lower. Some programs are more flexible, but 43% is the magic number to aim for. If your DTI is too high, you have two options: increase your income or decrease your debt. Paying off a small personal loan or a credit card with a high minimum payment before you apply can make a world of difference. Finally, the third pillar, savings. And I'm not just talking about the down payment. Yes, the down payment is the big one. The myth is that you always need 20% down. While putting 20% down helps you avoid something called private mortgage insurance, or PMI, it is not a requirement for many loans. There are FHA loans that allow as little as 3.5% down, and VA and USDA loans that can require 0% down for eligible borrowers. We'll cover all of those loan types in a future part. But the down payment is just the beginning of your cash-to-close needs. You also need to save for closing costs. These are the fees you pay to finalize the loan and the real estate transaction. They typically run between 2% and 5% of the home's purchase price. On a $300,000 home, that could be an extra $6,000 to $15,000 you need in cash on top of your down payment. And even that's not all. You need a buffer. A life happens fund. What happens if the water heater breaks the first month you move in? Or you discover a leak in the roof? Lenders like to see that you have cash reserves left over after you close, typically enough to cover at least 2 to 3 months of your new mortgage payment. This shows them you're not financially fragile and won't default on the loan at the first sign of trouble. So, before you open that Zillow app, open your banking app. Look at your credit score, calculate your DTI, and take a hard, honest look at your savings. This is your homework. This is the unglamorous but absolutely essential first step. Strengthening these 3 pillars is the single most powerful thing you can do to set yourself up for success. Now that you know how to assess your own financial health, you're ready to take the first step into the outside world of lending. But this is where another critical mistake is often made: confusing pre-qualification with pre-approval. They sound similar, but one is a casual estimate, and the other is a powerful tool that can make or break your ability to get your offer accepted. What's the difference? And why could handing a seller the wrong one sink your chances of getting your dream home? We'll break all of that down in the next part. One is a casual conversation, the other is a formal commitment. One is a pinky promise, the other is a contract signed in ink. Getting this wrong is one of the most common and heartbreaking mistakes first-time buyers make. So let's clear it up right now. First, you have the pre-qualification. This is the fast food version of getting ready to buy a home. You can often do it online in 15 minutes. You call up a lender or fill out a form, and you tell them your income, your estimated credit score, and how much you have in savings. Based on your numbers, the numbers you provided, they run a quick calculation and say, okay, based on what you've told us, you can probably afford a house up to this price. They give you a pre-qualification letter. It sounds official, but here's the catch. It's all based on unverified information. The lender hasn't seen your pay stubs, they haven't looked at your bank statements, and they haven't pulled your credit report. It's a guess, a ballpark estimate. It's you telling a lender you're a good baseball player, and them saying, cool, you could probably play in the major leagues then. It's not a guarantee you'll even make the team. Now let's talk about the pre-approval. This is the real deal. This is your golden ticket. A pre-approval is a conditional commitment from a lender to give you a mortgage for a specific amount. The key word there is commitment. To get pre-approved, you have to go through a much more rigorous process. This isn't a 15-minute chat. This is where you prove everything. You provide documentation, Pay stubs, W-2s, tax returns, bank statements. You give them your social security number so they can do a hard pull on your credit, which means they see the exact same credit report and FICO score that will be used for your actual loan. An underwriter, a real human being whose job is to assess risk, reviews your entire financial profile. After all that, if you meet their guidelines, the lender issues a pre-approval letter. This letter doesn't just say you might be able to get a loan. It says, "We have reviewed this person's finances, and we are prepared to lend them up to, say, $400,000, provided the house they choose meets our appraisal and inspection standards." So why does this matter so much? Imagine you're selling your home. It's a Saturday afternoon and you get two offers. Offer A is for your full asking price, and it comes with a pre-qualification letter. Offer B is for $1,000 less than your asking price, but it comes with a full pre-approval letter from a reputable bank. Which one do you choose? You choose offer B every single time. Why? Because offer B is a sure thing. The buyer has already been vetted. Their financing is solid. Offer A is a gamble. What if that buyer overestimated their income? What if they forgot about an old medical bill that tanked their credit score? If their loan falls through 3 weeks from now, you, the seller, have to put your house back on the market, losing precious time and momentum. A pre-approval tells a seller that you are a serious, credible buyer who has done the work and is ready to close the deal. In a competitive market, a pre-approval isn't just an advantage, it's a necessity. It's the key that gets you through the door. So, how do you get this golden ticket? The process can be broken down into 4 main pillars of documentation. Think of it as building a case for why you are a trustworthy borrower. The lender is looking at your income, your assets, your credit, and your employment. Let's start with income. The lender wants to see that you have a stable, reliable source of money coming in to make your mortgage payments. You'll need to provide your most recent pay stubs, usually for the last 30 days. You'll also need your W-2 forms from the last 2 years. The 2-year rule is important. Lenders love history. A 2-year track record at the same job or in the same industry shows stability. If you're self-employed or have income from a side hustle, don't worry, you can still get a loan. You'll just need to provide more documentation, typically your last 2 years of tax returns, to show a consistent earnings history. The goal is to paint a clear picture of what you earn and how consistently you earn it. Next up, assets. This is the money you have saved up. The lender needs to verify you have enough cash for 2 things: your down payment and closing costs, and what are called cash reserves. You'll provide bank statements usually for the last 2 to 3 months for all of your accounts: checking, savings, investment accounts, 401ks. The lender wants to see where the money for the down payment is coming from. And here's a massive pro tip. Lenders need to source all large deposits. If your parents gave you $20,000 last week to help with the down payment, that's great, but it needs to be documented with a gift letter. A random large cash deposit into your account right before applying for a loan is a huge red flag. They need to know it's not a secret loan you'll have to pay back. Let your money season in your account for a few months before you apply. As for cash reserves, this is money you'll have left over after you pay your down payment and closing costs. Lenders want to see that you won't be completely broke on day one. They typically want you to have enough in reserves to cover 2 to 3 months of your total mortgage payment. It's a safety net for you and for them. The third pillar is credit. This is your financial report card. When you apply for pre-approval, you'll authorize the lender to pull your full credit report and score from the 3 major bureaus: Equifax, Experian, and TransUnion. They'll typically use the middle of the 3 scores. Your FICO score is one of the most critical factors in your application. It determines not only if you'll get approved, but also what interest rate you'll get. A higher score means a lower interest rate, which can save you tens of thousands of dollars over the life of the loan. Before you even talk to a lender, you should pull your own credit report. You can do this for free once a year from the official government-mandated website. Check for any errors, any accounts you don't recognize, or any late payments that are incorrect. Fixing these issues before a lender sees them can dramatically improve your chances. Finally, we have employment. Even with all the pay stubs and W-2s, the lender will still perform a verification of employment, or VOE. This is exactly what it sounds like. They will contact your employer's HR department to confirm that you do, in fact, still work there, what your position is, and what your salary is. It's usually a standard routine process, but it's good to know it's coming. If you're thinking about switching jobs in the middle of the home buying process, don't. Just don't. Any change to your income or employment status can jeopardize your loan approval, even after you're pre-approved. Stay put until after you have the keys to your new house in your hand. Once the lender has all this, your income docs, your asset statements, your credit report, and your employment verification, the underwriter will review your complete file. If everything checks out, you'll get the call you've been waiting for. You're pre-approved. They'll send you that official letter stating the loan type you qualify for, the maximum amount they're willing to lend you, and the interest rate they're locking in for you, usually for a period of 60 to 90 days. This letter is your superpower. It's the proof you need to show sellers and real estate agents that you are a top-tier buyer. It also sets your budget. That maximum loan amount is your ceiling. Now you know exactly what price range you should be looking in. You're no longer just dreaming or guessing. You're an approved buyer, ready to hunt. But armed with this powerful pre-approval letter, your first instinct might be to jump on Zillow and start booking tours. And while that's the exciting part, there's a crucial step that most buyers skip. A step that separates a smooth, successful purchase from a stressful, chaotic one. You need to assemble your team. You wouldn't climb Mount Everest without a Sherpa. And you shouldn't navigate the real estate market without an expert guide. And just as important, you need to understand the number on your pre-approval letter isn't the number that actually matters for your monthly budget. What's the pity principle? And how can this 4-letter acronym save you from becoming house poor? And how do you find a rockstar real estate agent who will fight for you, instead of just trying to make a quick commission? That's what we're breaking down next. Let's start with pity. Piti. It sounds harmless, almost cute, but ignoring it is the #1 reason people end up house poor. Trapped in a home they can technically afford but that drains every last cent from their lives. Piti stands for principal, interest, taxes, and insurance. And this isn't just your mortgage payment. For most people, this is your total monthly housing expense, all bundled together. Let's break it down. Principal is the easy part. That's the money you actually borrowed. If you get a loan for $300,000, that's your principal. Every month, a piece of your payment goes to chipping away at that big number. In the beginning, it's a tiny piece, like taking a teaspoon to an iceberg, but over time it grows. Next is interest. This is the bank's fee for letting you borrow their money. It's the cost of the loan. And this is where the numbers get truly mind-boggling. A 0.5% difference in your interest rate might not sound like much, but on a $400,000 loan over 30 years, it can mean paying over $50,000 more. That's a brand new luxury car, a college fund, a life-changing amount of money, all decided by a tiny decimal point. This is why getting your finances in order before you talk to a lender is so critical. Your interest rate is a direct reflection of how risky the bank thinks you are. Okay, so principal and interest, P&I, that's the loan itself. Most first-time buyers get this. They use an online calculator, figure out the P&I payment and think, yeah, I can afford that. But they're missing the other half of the equation, the silent budget killers. First up is T for taxes. Property taxes. This isn't a one-time thing. It's a forever thing. You pay it every single year you own your home. This money funds local schools, roads, police, and fire departments. The amount you pay is determined by your local government and is based on the assessed value of your home. And here's the scary part. It can and often does go up. That brand new school they're building down the street? Your property taxes are probably going to help pay for it. That fixed mortgage payment you thought you had? It's not so fixed when the tax bill changes. In some states like New Jersey or Texas, property taxes can add $500, $800, even over $1,000 to your monthly payment. Forgetting to account for this is like planning a road trip but forgetting to budget for gas. You won't get very far. Finally, the second I, insurance. Homeowners insurance is mandatory. Your lender will not give you a penny until you have proof of a policy. This protects the home, their asset, from things like fire, hail, or theft. But that's not the only insurance you might need. If you put down less than 20%, your lender will almost certainly require you to pay for PMI or private mortgage insurance. This isn't insurance for you. It's insurance for the lender in case you stop paying. Protects them, but you foot the bill. And depending on your loan and credit, PMI can add a few $100s to your monthly payment. On top of that, are you in a flood zone? You'll need separate flood insurance. In California, you might need separate earthquake insurance. So you see, your mortgage pre-approval for $2,000 a month isn't the whole story. Add $600 for taxes, $150 for insurance, and another $200 for PMI, and suddenly your real payment, your pity, is nearly $3,000. That's the trap. The bank pre-approves you based on what you can pay them back, the principal and interest. They don't really care if you have enough left over for groceries, gas, or saving for retirement after you pay the taxes and insurance. Understanding your total pity is your shield. It's how you stay in control and buy a home that serves your life, not a life that serves your home. Now, calculating all this can feel overwhelming. How are you supposed to know the property taxes on a house you haven't even found yet? How do you estimate insurance? This is where you transition from the numbers to the people. You need a guide, a champion. You need a rockstar real estate agent. And I use the word rockstar intentionally, because a mediocre agent, a part-time agent, or your cousin who just got their license can cost you tens of thousands of dollars or worse, help you buy the wrong house. Finding a great agent is as important as finding a great lender. They are the two pillars of your home buying team. So how do you find one? You don't just call the number on a for sale sign. That agent works for the seller. Their legal and fiduciary duty is to get the best deal for the person selling the home, not for you. You need a buyer's agent, someone who is 100% in your corner. The process for finding them is simple. You need to conduct job interviews. You are hiring someone for the biggest financial transaction of your life. Treat it with that level of seriousness. Aim to interview at least 3 different agents. Here's what you're looking for. First, hyperlocal expertise. You don't want an agent who works across the entire state. You want the agent who lives and breathes the 2 or 3 towns you're interested in. They know which streets flood when it rains. They know the reputation of the local elementary school. They know that the houses in one subdivision are known for having foundation issues. This kind of on-the-ground knowledge is priceless and can't be found on Zillow. Second, you're looking for a teacher, not a salesperson. A great agent's goal isn't to sell you a house. It's to educate you so you can make the best decision for yourself. During your interview, notice if they are listening more than they are talking. Do they ask you deep questions about your lifestyle, your commute, your 5-year plan? Or do they just ask about your budget and number of bedrooms? A great agent will point out the negatives of a house: the old roof, the water stain in the basement, the awkward layout. A bad agent will only talk about the new kitchen countertops and the great backyard for barbecues. You want an advisor, a skeptic, someone who is actively trying to protect you from making a bad purchase. Third, ask about their process, especially in a competitive market. Don't just ask, "Are you a good negotiator?" Everyone will say yes. Ask specific behavioral questions. Tell me about a time you helped a buyer win in a multiple offer situation without just being the highest price. What's your strategy when we find the perfect house? How do you communicate? Text, email, phone calls? How quickly can I expect a response? Their answers will reveal their experience and their style. You need someone whose communication and work style matches your personality. If you're an anxious person, an agent who only texts back once a day is going to be a nightmare for you. And finally, ask for references. And don't just get the list of glowing 5-star clients they hand you. Ask specifically, "Could I speak with your 2 most recent clients?" This gives you a real-time look at how they operate in the current market. There are also some major red flags to watch out for. An agent who immediately tries to push you to the absolute top of your pre-approval budget. An agent who dismisses your concerns. And a big one, an agent who pressures you to sign a buyer's agency agreement at your very first meeting. This is a contract that locks you into working with them exclusively for a set period. You should never sign this until you are 100% confident they are the right person for the job. Finding the right agent is about building a relationship of trust. This is the person who will guide you, fight for you, and ultimately hand you the keys to your new home. They will connect you with inspectors, attorneys, and other professionals. They are the quarterback of your team. Once you have your financing lined up and your rockstar agent by your side, you've moved past the preparation stage. You've built your foundation. Now the real hunt begins. But in a world of curated photos and deceptive descriptions, how do you separate the hidden gems from the money pits? How do you read a property listing like a detective, spotting the red flags and code words before you even waste your time on a showing? And what are the things you absolutely must look for the moment you step inside a potential home? Things that most buyers completely miss. We're going from the finances to the front lines of house hunting, and that's exactly what's coming up next. You've got that pre-approval letter in your hand. It feels like a golden ticket, a license to dream. You start swiping through Zillow and Redfin like it's a dating app for houses. This is the fun part, right? The part you see on TV shows where a happy couple walks into 3 perfect houses and just picks one. Well, I'm here to tell you the reality is a little different. And the biggest mistakes aren't made at the closing table, they're made the second you walk through that front door for the first time. completely unprepared. The digital hunt is a fantastic starting point, but it's also a world of illusions. Wide-angle lenses make tiny rooms look palatial. Digital staging can furnish an empty, decrepit space to look like a showroom. And those beautiful sun-drenched photos? They were taken on the one day of the year the sun actually hits that window. You cannot, and I repeat, cannot get a true feel for a house through a screen. You have to get on the ground. But you don't go into battle alone. Your first and arguably most important team member in this phase is your buyer's agent. Now, a common misconception is that you have to pay a real estate agent thousands of dollars out of your pocket. For a buyer, in the vast majority of cases, this is completely false. Your agent's commission is typically paid by the seller from the proceeds of the sale. This means you get a dedicated professional, an expert negotiator, and a local guide for free. It is one of the single best deals in the entire home buying process. But not all agents are created equal. A great agent isn't just someone who unlocks doors. A great agent listens. They understand your non-negotiables. They're a bloodhound for new listings that match your criteria, sometimes even finding properties before they officially hit the market. They're also your first line of defense. They've seen hundreds of homes. They can spot a potential problem from a mile away and will tell you, "You know what, the photos looked great, but I think we should pass on this one, and here's why." A bad agent is just a driver. They're trying to make a quick commission and will push you toward any house just to close a deal. Interview at least 3 agents. Ask them about their experience with first-time buyers. Ask for references. This is a business partnership that could determine the fate of your largest financial investment. Choose wisely. Once you have your agent, it's time to get brutally honest with yourself. Before you look at a single house, you need to create 2 lists, your must-haves and your nice-to-haves. This is non-negotiable. The emotional pull of a beautiful kitchen or a charming backyard can make you forget all your priorities. Your must-haves are the deal breakers. Things like the number of bedrooms, a specific school district, a commute under 45 minutes, or a garage. If a house doesn't have these, it's an automatic no. No matter how gorgeous the staging is. Your nice-to-haves are the things you'd love, but could live without. A finished basement, a walk-in closet, granite countertops, a fenced-in yard. This list is your trade-off currency. You might find a house with all your must-haves that's at the top of your budget. Then you find another one that's $20,000 cheaper, has all your must-haves, but is missing a few of your nice-to-haves. That's a smart trade. Without these lists, every house becomes a confusing emotional calculation. With them, it becomes a logical business decision. Alright, the lists are made, your agent is ready. You pull up to the first house. Your heart is pounding. This is it. You walk in, and your eyes immediately go to the shiny new appliances and the freshly painted walls. This is what the seller wants you to see. But you're going to be a home buying expert. You're going to look past the superficial and see the bones. Here's your new checklist. The things you look for that 99% of buyers miss. First, use your feet. As you walk through the house, do you feel any slopes or soft spots in the floor? A gentle, consistent slope might just be an old house settling, but a pronounced dip, a bouncy floor, or a feeling of walking uphill can be a sign of a major, and I mean major foundation or structural joist issue. This is a 5- or 6-figure problem disguised as a quirky floor. Second, look up. Scan every single ceiling and the top corners of every wall. Are there faint brownish yellow water stains? Even if they're dry and have been painted over, it's evidence of a past leak. Where did it come from? The roof? An upstairs bathroom? Is the problem truly fixed? Or is it a ticking time bomb waiting for the next heavy rain? Third, use your nose. The moment you walk in, take a deep breath. What do you smell? Pet odors? Lingering cigarette smoke? These can be incredibly difficult to get out of carpets, walls, and even the ductwork. Do you smell a musty, mildewy scent, especially in the basement or bathrooms? That's a huge red flag for moisture and mold problems. And be wary of the opposite. An overwhelming smell of air fresheners, candles, or fresh paint. An aggressive cover-up scent is often hiding something worse. Fourth, become a detective. Don't be shy. Open things. Look under the kitchen and bathroom sinks. Do you see active drips, water damage in the cabinet, or signs of old leaks? Find the home's major systems. Look at the water heater. There's usually a sticker on it with the manufacturing date. Is it more than 10 years old? You're likely on borrowed time and will need to replace it soon. Find the HVAC unit, the furnace or air handler. Same thing. Look for a date. An HVAC system is one of the most expensive components of a home to replace. A 20-year-old furnace is a multi-thousand-dollar bill waiting to happen. Ask about the age of the roof. A new roof can cost $10, $15, even $20,000 or more. If the seller doesn't know, a good agent can often spot an aging roof from the ground by looking for curling or missing shingles. Fifth, look at the windows. Are they single pane and ancient? That means poor insulation and high energy bills. Is there condensation between the panes of a double pane window? That means the seal has failed and the window has lost its insulating properties. Replacing all the windows in a house is another massive expense. And finally, the most overlooked step of all, investigate the outside. Walk the perimeter of the house. Do you see any cracks in the visible foundation? Is the ground sloping towards the house instead of away from it? That's a recipe for a flooded basement. Listen, what do you hear? Is there a constant hum from a nearby highway? Are you directly under a flight path? Is the neighbor's dog barking incessantly? Take a moment and just stand on the street. What's the vibe? And here's a pro tip. Visit the neighborhood at different times. The quiet, peaceful street you saw on a Tuesday at 10 a.m. might be a chaotic neighborhood drag strip on a Friday night. Drive by in the morning during rush hour and late at night before you even think about making an offer. This all sounds like a lot. It sounds clinical and unromantic. And it is. You have to separate the emotional, I can see us living here, from the rational, will this house bankrupt us? You can fall in love with a house, but you have to do it with your eyes wide open. You can change paint colors, update kitchens, and landscape a yard. You cannot easily change a failing foundation, a leaky roof, or a bad location. Focus on the bones, the big three: roof, foundation, and major systems. Everything else is just cosmetic. So you've done it. You've inspected a dozen homes. You've seen the good, the bad, and the truly ugly. You've dodged a few bullets and passed on houses with serious red flags. But then you find it. The one that checks all the must-have boxes. The one with bones that feel solid. The one that just feels right. You're ready. You're ready to make an offer. But how much do you offer? Do you go in at asking price? Below? Above? What are contingencies? And why are they your most powerful negotiation tool? How do you write an offer that a seller will actually accept in a competitive market without giving away the farm? Making the offer is where the game truly begins, and that's where we're going next. Think of your offer not as a single number, but as a complete package, a strategic proposal designed to solve the seller's problem, which is selling their house, while protecting you from a financial catastrophe. This isn't just about putting a price on a piece of paper. This is a game of information, psychology, and negotiation. And it all starts with the 4 core components of any strong offer. First, and most obviously, is the offer price. This is the big, flashy number everyone focuses on, but deciding on it is more art than science. Your agent is your most valuable player here. They'll run what's called a comparative market analysis, or CMA. In simple terms, they're looking at what similar homes, the comps, in that exact neighborhood have sold for in the last few months. They're comparing square footage, number of bedrooms, lot size, upgrades, and condition. Are you in a buyer's market where houses sit for weeks and prices are dropping? You might offer below the asking price. Or are you in a seller's market, a frenzy where homes get 10 offers in a weekend? You'll likely need to go over the asking price. The price you offer sends a signal. Too low, and you might insult the seller and not even get a response. Too high without justification, and you risk the house not appraising for that value later on, which we'll get to in a moment. Your price needs to be competitive, but it also has to be rooted in reality, the reality of the market data. But here's the secret the pros know. The price is often not the most important part of the offer. The second component is where you protect yourself. These are your contingencies, and they are your get-out-of-jail-free cards. A contingency is simply a condition that must be met for the sale to go through. If the condition isn't met, you can walk away from the deal and, crucially, get your deposit back. There are 3 main contingencies you absolutely need to understand. The first is the inspection contingency. This gives you a set period of time, usually 7 to 14 days, to have a professional home inspector come in and scrutinize every inch of that house: the foundation, the roof, the plumbing, the electrical, everything. If the inspector finds a hidden nightmare like a cracked foundation or evidence of a major leak, this contingency allows you to do one of 3 things. Ask the seller to fix the issues, ask for a credit to fix them yourself, or if the problems are too big, walk away from the deal completely. Without this contingency, you buy the house as is. That leaky roof? It's your problem now. That faulty wiring? Your bill. The inspection contingency is your single most important shield against buying a money pit. Next is the appraisal contingency. This one is for your lender's protection, and by extension yours. After you go under contract, your lender will order an independent appraisal to make sure the house is actually worth the price you've agreed to pay. Why? Because the house is the collateral for the loan. The bank won't lend you $400,000 for a house that they believe is only worth $380,000. If the appraisal comes in low, this contingency kicks in. It gives you the power to renegotiate the price with the seller down to the appraised value. If the seller won't budge, you can walk away from the deal without penalty. Without this contingency, you'd be on the hook for making up that $20,000 difference in cash out of your own pocket, on top of your down payment. It's a financial landmine you want to avoid at all costs. The third is the financing contingency, also known as a mortgage contingency. This clause states that your offer is dependent on you successfully securing a loan. Remember that pre-approval letter? It's strong, but it's not a final ironclad guarantee. The underwriter still needs to review your entire file. If for some unforeseen reason, a sudden job loss, a new debt appearing on your credit report, your loan gets denied at the last minute, this contingency lets you back out and reclaim your deposit. Without it, if your financing falls through, the seller could potentially keep your deposit and in some cases, even sue you for damages. These three contingencies are your holy trinity of protection. They are the safety net that lets you confidently make an offer on the biggest purchase of your life. The third component of your offer is the earnest money deposit, or EMD. This is a good faith deposit you make to show the seller you're serious. It's not extra money. It's part of your down payment that you're just paying up front. The amount varies by market, but it's typically 1 to 3% of the purchase price. So on a $400,000 home, you might put down $4,000 to $12,000. This money doesn't go to the seller directly. It's held in a neutral third-party account, called an escrow account, until closing. If the deal goes through, it's applied to your down payment and closing costs. If you back out for a reason covered by one of your contingencies, you get it back. But if you just wake up one day and get cold feet for no valid reason, you risk forfeiting that deposit to the seller. Finally, the fourth component is the proposed closing date. This is the day you officially take ownership of the house. A standard closing period is 30 to 45 days, which gives the lender enough time to process the loan. But this date can be a powerful negotiation tool. Does the seller's listing say they need to move quickly for a new job? Offering a faster 21-day close could make your offer more attractive than a higher-priced one with a 45-day close. Conversely, do the sellers need to find their next home? Offering a longer closing or even a rent-back agreement, where you let them rent the home from you for a month after closing, could be the key that gets your offer accepted. So you have the price, the contingencies, the earnest money, and the closing date. Your agent bundles all of this into a formal, legally binding purchase agreement, and you sign it. You hit send, and then you wait. This is often the most nerve-wracking part of the entire process. In a competitive market, however, a standard offer might not be enough. You might need to pull out some advanced strategies. One is an escalation clause. This is a special addendum that says, I will pay X amount for this house, but if you receive another higher offer, I am willing to increase my offer to be $2,000 more than that competing offer, up to a maximum price of Y. This lets you compete in a bidding war without immediately putting your absolute highest number on the table. It's a powerful tool, but it also reveals your hand to the seller. They now know your maximum limit. Then there's the controversial buyer love letter. This is a personal letter you write to the seller explaining why you love their home and envision your future there. The idea is to create an emotional connection. While this can sometimes work, many states are now discouraging or even banning them due to fair housing concerns, as they can unintentionally introduce bias into the transaction. Always check with your agent about the local laws and customs. And now for the nuclear option: waiving contingencies. In the most cutthroat markets, buyers will sometimes waive their inspection or appraisal contingency to make their offer look cleaner and stronger to a seller. Let me be crystal clear. This is an incredibly high-risk strategy. Waiving an inspection means you are accepting the house and all its potential hidden flaws, period. Waiving an appraisal contingency means you are guaranteeing you will pay the difference in cash if it appraises low. This is a gamble that can cost you tens of thousands of dollars. It should only ever be considered in very specific circumstances and after a long, serious conversation with your real estate agent and financial advisor about the absolute worst-case scenarios. Once your offer is submitted, the seller has three possible responses. They can accept it. Congratulations, you're under contract. They can reject it outright. Or the most common outcome, they can issue a counteroffer. They might come back with a higher price, a different closing date, or they might ask you to change a contingency. The counteroffer isn't a rejection. It's an invitation. It's the seller saying, "We're close, let's negotiate." And that negotiation, that back and forth dance of counteroffers, is where deals are won and lost. It's how you turn a good offer into a great deal, and it's the critical next step on your path to getting the keys. Your real estate agent calls. Your heart is pounding. You see their name on the screen and you either brace for impact or hope for a miracle. And then you hear the words, "They accepted the offer." For a split second, the world stops. You did it. You're getting the house. The celebration is immediate. You're calling your partner, your parents, your dog. But then, a new feeling starts to creep in. A heavier, more serious feeling. Feeling of, "Oh wow, this is real." What happens now? What happens now is you officially go under contract. This is the moment the game changes. Up until now, it's been a lot of looking, talking, and planning. Now it's about execution. Being under contract, sometimes called being in escrow, means you and the seller have signed a legally binding purchase agreement. This isn't a handshake deal anymore. It's a stack of paper that dictates the exact terms, timeline, and conditions for the sale of the property. Think of it as the official rulebook for the most important financial transaction of your life. And the first rule in that book, you have to put your money where your mouth is. This is called the earnest money deposit, or EMD. This is your good faith deposit. It's a check you write, typically for 1 to 3% of the purchase price, that gets deposited with a neutral third party like an escrow company or a closing attorney. This isn't extra money. It will be credited back to you at closing, usually applied towards your down payment or closing costs. But its purpose is crucial. It shows the seller you are a serious, committed buyer. It's you saying, "I'm not going to waste your time. I'm putting my own cash on the line to prove it." Because here's the scary part. If you back out of the deal for a reason that isn't covered by a contingency in your contract, you can lose that earnest money. The seller gets to keep it. So a $30,000 deposit on $1 million home isn't just a number on a page. It's a powerful incentive to see this thing through to the end. But don't panic. You're not just handing over a huge check with no safety net. This is where the most important part of your purchase agreement comes into play. The contingencies. Contingencies are your escape hatches. They are conditions that must be met for the sale to proceed. If a contingency is not met, you have the right to walk away from the deal and, most importantly, get your earnest money back. There are 3 major contingencies you need to understand like the back of your hand. First, the inspection contingency. This is your right to have the home professionally inspected. You'll hire a licensed home inspector, and please do not skip this step to save a few $100, who will spend hours crawling through the attic, peering into the crawl space, testing every outlet, and examining the foundation. They are looking for problems big and small. A few days later, you'll receive a detailed report, often 50 pages or more, filled with photos and descriptions of everything from a leaky faucet to a cracked foundation. This report is your leverage. No house is perfect, but if the inspection uncovers major issues, say the roof has only 2 years of life left, or the furnace is on its last legs, you don't have to just accept it. You and your agent go back to the seller and enter a second round of negotiations. You can ask for a credit at closing, request that they make the repairs before you move in, or even ask for a price reduction. If you can't come to an agreement, the inspection contingency allows you to say, "Nope, this isn't the house for me," and you can cancel the contract, getting your earnest money back. Second is the appraisal contingency. This one isn't about you. It's about the bank. The lender is not going to give you a $500,000 loan for a house that's only worth $450,000. So they will hire an independent, licensed appraiser to determine the home's fair market value. The appraiser will research recent comparable sales in the neighborhood, measure the property, and assess its condition to come up with a professional valuation. This is a nail-biting moment. If the appraisal comes in at or above your offer price, everyone breathes a sigh of relief. But what if it comes in low? This creates what's called an appraisal gap. Let's say you offered $500,000, but the appraisal says it's only worth $480,000. The bank will only lend you money based on the lower value. You now have 3 options. 1, you can try to negotiate with the seller to lower the price to the appraised value. 2, you can come up with the $20,000 difference in cash yourself on top of your down payment. Or 3, if you can't do either of those, the appraisal contingency allows you to walk away from the deal with your earnest money intact. And third, the most important one for this series, the financing contingency, also known as the loan contingency. This is your ultimate safety net. It states that the purchase is conditional on you being able to secure the loan you've applied for. You have a pre-approval, which is great, but that's not a final guaranteed loan. The final approval only comes after a deep dive into your finances by an underwriter. If, for some unforeseen reason, a last-minute job loss, a sudden credit score drop, or some other issue the lender discovers, your loan gets denied, this contingency protects you. It allows you to cancel the contract because you literally cannot get the money to buy the house. Without it, you could be legally obligated to buy a house you can't afford, lose your earnest money, and even be sued by the seller. While you're navigating these contingencies, your loan officer kicks into high gear. The pre-approval phase is over. You now have a live loan application. And this begins the great paper chase. Prepare yourself because your lender is about to ask you for a mountain of documents. This is the part that drives most buyers crazy, but it's all for a reason. They have to verify every single piece of information on your application. They'll want your last 30 days of pay stubs to confirm your income. They'll want your last 2 months of bank statements, every single page, even the blank ones, to verify your assets and source your down payment. They'll scrutinize every large deposit. Got a $10,000 gift from your parents? You'll need a signed gift letter from them and proof the money left their account and entered yours. Sold some stock? They'll want the trade confirmations. They'll ask for your last 2 years of W-2s and federal tax returns. If you're self-employed, get ready for 2 years of business tax returns and a year-to-date profit and loss statement. You'll be working with a loan processor. This is the person on your lender's team who acts as the file manager. They gather all your documents, organize them, and prepare the file for the final decision maker, the underwriter. They will likely ask you for things that seem completely insane. A letter of explanation for a credit inquiry from 3 years ago. A letter explaining why you have a different address on your driver's license than on your bank statement. A letter explaining a random $500 Venmo deposit from a friend. The key is, don't fight it. Don't delay. Just get them what they ask for as quickly and as cleanly as possible. Every day you delay is another day you're not closer to closing. They're not being nosy, they're building a case. They are creating a story with your documents that proves to the underwriter that you are a responsible borrower who will pay back this very large sum of money. Sometime during this flurry of paperwork and inspections, you'll have another critical decision to make: locking your interest rate. An interest rate lock is a guarantee from the lender to hold a specific interest rate for you for a set period, typically 30, 45, or 60 days. Interest rates can change daily, even hourly. A rate lock protects you from a sudden spike in rates while your loan is being processed. If you lock at 5% and rates jump to 5.5% the next week, you still get your 5%. It's a powerful tool. The decision is when to lock. Your loan officer will advise you, but it's your call. You have to balance the risk of rates going up against the possibility that they might go down. Once you lock, you're committed. So you've survived the inspection, the appraisal came in at value, and you've uploaded a forest's worth of financial documents to your lender's online portal. Your file is now considered complete. You've done your part. You've answered every question, explained every deposit, and signed every initial disclosure. Your loan processor packages it all up, puts a digital bow on it, and sends it on its way. It now lands on the desk of the most feared and mysterious person in the entire mortgage process. The final gatekeeper. The one who holds the power to say yes or no. It's time for underwriting. It's time for underwriting. If the mortgage process were a video game, the underwriter is the final boss. They are the ultimate authority, the person in a quiet office somewhere, poring over every single digit of your financial life. Their job isn't to be mean, and it isn't to find a reason to say no. Their one and only job is to protect the lender's investment by ensuring your loan meets all the required guidelines, and most importantly, that you have the ability and the willingness to pay it back. They are the ultimate fact checker, the quality control specialist for the single biggest financial transaction of your life. So what are they actually looking at? What is this mythical underwriting process? It all boils down to a concept lenders have used for decades, often called the 3 C's of credit, sometimes 4. Think of it as the underwriter's holy trinity for evaluating your loan file. The first, and arguably most important, is capacity. This is the raw math. Can you actually afford this payment? The underwriter is going to live inside your debt-to-income ratio. They're going to verify every single source of income you listed. That overtime you get? They'll want to see a 2-year history to prove it's consistent. That side hustle you have? They'll need to see tax returns to prove it's a stable business, not just a one-time cash grab. They're looking for stability. A long history at the same job is fantastic. Hopping between 3 different jobs in the last year? That might raise a red flag they'll need you to explain. They are building a picture of your financial horsepower. Do you have enough engine to carry this new mortgage payment plus all your existing debts without blowing a gasket? They'll also scrutinize your bank statements. And they're looking for one thing in particular: large undocumented deposits. Why do they care if your grandma gave you $5,000 for your birthday? Because to them, an undocumented deposit isn't a gift. It's a potential secret loan. If your grandma lent you that money and expects it back, that's another monthly payment you have that wasn't disclosed on your application. And that throws your entire debt-to-income ratio out of whack. Every dollar needs a paper trail. The second C is credit. This is your financial report card. It tells the story of how you've handled debt in the past. The underwriter will pull a fresh, comprehensive credit report from all 3 major bureaus: Equifax, Experian, and TransUnion. They aren't just looking at your score, though that's a huge factor. They are reading the story. Have you paid your bills on time every time? Do you have a history of late payments on credit cards or car loans? How much of your available credit are you using? High credit card balances can be a sign of financial stress. They'll also look for major derogatory events like bankruptcies, foreclosures, or collections. The past is the best predictor of the future, and your credit history is the underwriter's crystal ball. The third C is collateral. This isn't about you at all. It's about the house. The lender is giving you hundreds of thousands of dollars, and the house is the security, the collateral for that loan. If you stop paying, they take the house to get their money back. So the underwriter needs to be absolutely certain the house is worth what you're paying for it. This is where the appraisal we talked about becomes critical. The underwriter reviews the appraisal report with a fine-tooth comb. Does the value make sense for the neighborhood? Are the comparable sales the appraiser used really comparable? Are there any health and safety issues noted, like a leaky roof or faulty wiring? If the appraisal comes in lower than the sales price, alarm bells go off. The lender will not lend you more money than the house is worth. The collateral has to be solid. And the bonus, fourth C, is capital, also known as assets. The underwriter needs to verify you have the cash to close. This means your down payment and your closing costs. But just like with those large deposits, they need to know where this money came from. It needs to be sourced and seasoned. Seasoned just means the money has been sitting in your account for a while, typically at least 60 days, proving it's your money and not a last-minute loan you forgot to mention. If you recently received a large gift from a relative for the down payment, that's usually okay, but it requires a formal gift letter and proof the money came from the gift giver's account. They need to connect every dot. So your file lands on the underwriter's desk. They open it up and the interrogation begins. They'll compare your pay stubs to your W-2s, your W-2s to your tax returns, and your tax returns to your bank statements. They're looking for consistency. Does everything line up? Does the story make sense? Now, here's what almost everyone gets wrong. You might think the goal is a one-and-done approval. In reality, that almost never happens. The most common outcome of the first review is something called a conditional approval. This is the part that sends first-time buyers into a panic, but it's completely normal. A conditional approval sounds like this: congratulations, we've approved your loan, on the condition that you provide us with a few more things. These conditions are the underwriter's questions. They're the loose threads they need you to help them tie up. Condition could be anything. It might be simple, like please provide your most recent pay stub, because a new pay period passed while your file was in the queue. It might be a request for a letter of explanation or locks. Please explain the credit inquiry from the furniture barn on April 22nd. Or, please write a letter explaining the source of the $3,000 cash deposit into your checking account 2 months ago. They might need documentation for the property, like please provide proof the seller has repaired the broken fence noted on page 7 of the appraisal. This is not a rejection. I repeat, this is not a rejection. It is a conversation. The underwriter is simply asking for more information to make their final decision. You and your loan officer will work together to gather up all the requested documents, the conditions, and send them back to the underwriter for a final review. Sometimes this can go back and forth a couple of times. They ask for one thing, you provide it, and that document makes them think of a new question. It can be frustrating, but it's part of the process of making sure your loan is bulletproof. And then, after all the questions have been answered, after every document has been verified and every number has been triple-checked, you get the 4 most beautiful words in the entire home buying journey. Clear to close. Clear to close, or CTC, is the final unconditional loan approval. It's the underwriter giving the official green light. It's the lender saying, "We are ready. The money is yours. Go buy your house." This is the moment you can finally truly relax, knowing that the financing is secured. The biggest hurdle is behind you, but while your file is in underwriting, you have one job, one critical, non-negotiable mission. Become the most boring financial person on the planet. Do not make any sudden moves. The underwriter has approved a very specific snapshot of your financial life. Your job is to keep that snapshot exactly the same until you have the keys in your hand. This means do not quit or change your job. Do not buy a new car, a boat, or a room full of furniture on credit. Do not co-sign a loan for your cousin. Do not open new credit cards. Do not close old credit cards. Do not make any large, unexplainable cash deposits. Any one of these actions can change your debt, your income, or your assets, and force your loan to go back through underwriting. It's the #1 reason closings get delayed or, in the worst-case scenario, fall apart at the last minute. Be boring. Your new couch can wait. You've survived the interrogation. You've answered the questions and passed the test. The gatekeeper has opened the gate. You have your clear to close. The finish line is closer than ever. Now it's time to prepare for the final ceremony. The event where you sign your name until your hand cramps and officially become a homeowner. It's time to talk about your closing disclosure and the final steps to the closing table. This is it. The final countdown. Everything you've worked for, the searching, the offers, the underwriting gauntlet, it all comes down to these last few days. And the document that kicks off this final phase is one of the most important pieces of paper you will ever receive. It's called the closing disclosure, or the CD. Think of it as the final legally binding report card for your home loan. All the estimates, all the ballpark figures, they're gone. The numbers on this 5-page document are the real, hard numbers. This is what you will actually pay. By federal law, your lender is required to give you this closing disclosure at least 3 full business days before your scheduled closing date. This isn't a suggestion. It's a non-negotiable cooling-off period called the TRID rule, designed to protect you. It gives you time to review every single line item without being rushed at the closing table. And let's be clear about what a business day means here. It includes Saturdays but not Sundays or federal holidays. So if you receive your CD on a Tuesday, the earliest you can close is Friday. If you get it on a Thursday, the earliest you can close is the following Monday, assuming Friday and Saturday are normal business days. This 3-day window is your golden opportunity to be your own best advocate. Do not squander it. The moment that CD hits your inbox, your mission is simple. Compare it line by line to the last loan estimate you received. Your lender gave you that loan estimate when you locked your rate, and its entire purpose was to set expectations. Now is the moment of truth. Pull them up side by side on your screen. The first page is the most critical. Look at the loan terms. Is the loan amount exactly what you expected? Is the interest rate the same when you locked in? Is the monthly principal and interest payment correct? These numbers should be identical. If they're not, you need to call your loan officer immediately. This is a red alert situation. Next, look at the projected payments section. This will show your total monthly payment, often called PITI. Principal, interest, taxes, and insurance. The principal and interest part should be stable, but the taxes and insurance portion might be slightly different from the estimate, as those are third-party figures that can be finalized late in the game. It shouldn't be a massive swing, but some minor adjustment is normal. Now scroll down to the section that makes everyone's heartbeat a little faster. The costs at closing, specifically the calculating cash to close table. This is the final definitive number for the amount of money you need to bring to the closing table. Again, compare this to your loan estimate. Certain fees have what's called a zero tolerance for change. This means they cannot increase at all from the loan estimate to the closing disclosure. These include any fees paid directly to the lender or mortgage broker, like your origination fee, and the cost for any third-party service you were required to use from the lender's approved list, like the appraisal or credit report fee. If these numbers have gone up, it's a problem. Other costs have a 10% tolerance. meaning the total sum of these specific fees can't increase by more than 10%. This category typically includes recording fees and fees for services where the lender lets you shop around, like the title search and title insurance. Finally, some costs can change without limitation. These are things like your prepaid homeowner's insurance premium, initial escrow deposit, and per diem interest. Don't panic if these have shifted slightly, but do ask your loan officer to explain any changes you don't understand. Your job is not to be a mortgage expert. Your job is to ask questions until you are 100% comfortable with every single dollar you're being asked to pay. If you see a charge you don't recognize, like a document prep fee or a processing fee that wasn't there before, question it. This is your money and your loan. Reviewing this document is your final exam, and you need to ace it. Once you've reviewed and approved the closing disclosure, you will know the exact to the penny amount for your cash to close. Now, how do you actually get this money to the closing? You can't just write a personal check for $63,000. For security reasons, the title company or closing attorney will require guaranteed funds. This means you have two primary options: a cashier's check or a wire transfer. A cashier's check is a check issued by your bank and drawn on the bank's own funds, guaranteeing it won't bounce. You'll go to your bank, tell them the exact amount and who to make it payable to, get this information from the title company, and they'll print it for you. The other, more common method is a wire transfer. And this is where I need you to listen very, very carefully. This is the single most vulnerable point in the entire home buying process for financial fraud. Scammers are sophisticated. They hack into email accounts and send fraudulent wiring instructions that look completely legitimate. They'll change 1 or 2 digits in the account number, and your life savings will be sent to a criminal's account, likely overseas, and it will be gone forever. This is not a scare tactic. It happens every single day. So here is the unbreakable rule. Never, ever initiate a wire transfer based on instructions you received in an email. Period. You must verbally confirm the wiring instructions. Find the phone number for your title company or closing attorney from an independent source, like their official website or the original contract you signed. Not from the email itself. Call them directly. Speak to a person you know. Read the account number and routing number out loud to them, and have them confirm that it is 100% correct. Then, and only then, should you go to your bank to send the wire. Be paranoid. Be redundant. A 10-minute phone call can save you from a lifetime of regret. With the money situation handled, you have one last mission before closing day: the final walkthrough. This usually happens 24 to 48 hours before closing. This is not a home inspection. That's already done. This is a final check to ensure the property is in the condition you agreed to buy it in. First, you're making sure the seller has actually moved out and hasn't left a basement full of junk for you to deal with. Second, you're verifying that any contractually obligated repairs have been completed. If the seller agreed to fix a leaky faucet or replace a broken window, you need to see it with your own eyes and ideally have the receipts for the work. Third, you're confirming that nothing has gone wrong with the house since you last saw it. Turn on every light switch. Run the water in every faucet and flush every toilet. Turn on the heat and the air conditioning no matter the season to make sure they kick on. Test the appliances that are staying with the home. I once heard of a buyer who skipped the final walkthrough, only to discover on moving day that the sellers had swapped out the high-end stainless steel refrigerator for a rusty old one from the garage. Because they had already closed, they had almost no recourse. The final walkthrough is your last chance to identify a problem before the home, and all its problems become legally yours. If something is wrong, you immediately call your real estate agent and the closing attorney. Do not close until the issue is resolved. You've reviewed the numbers. You've secured the funds. You've walked through the home one last time. Now you just need to prepare for the day itself. Gather your documents. You'll need a valid government-issued photo ID, like a driver's license or passport. Make sure it's not expired. Bring a copy of your sales contract and the closing disclosure. If you're bringing a cashier's check, guard it with your life. If you've wired the money, bring the wire confirmation receipt. It's also not a bad idea to bring your personal checkbook, just in case there are any minor last-minute adjustments that fall within what a personal check can cover. Get a good night's sleep. The closing appointment can take anywhere from 30 minutes to 2 hours, and it's a marathon of signing. Your hand will hurt. You will see more documents than you ever thought possible. But you are prepared. You've done your homework. You've checked the numbers and protected your money. You are walking into that room not as a nervous first-timer, but as an informed, empowered buyer ready to claim your prize. You are at the 1-yard line. The keys are so close you can almost feel their weight in your hand. You're ready to walk into that office, sit down at that big table and make it official. This is it. The day you've been working towards for months, maybe even years. Welcome to closing day. But before you even sit down at that table, there's one final critical mission you must complete. The final walkthrough. This is usually done the day of or the day before closing. This is not a home inspection. The inspector's job is long done. This is your last chance to verify that the property is in the exact condition you agreed to buy it in. You're checking that the seller has moved out completely, that no new damage has occurred since your last visit, and that any contractually agreed upon repairs have actually been finished. So what are you looking for? First, turn on every single light switch. Run the water in every faucet. Check for hot water and flush every toilet. You'd be amazed what can happen in the chaos of a move out. Run the garbage disposal and the exhaust fans. Test the heating and the air conditioning no matter the season. Open and close every window and door. You're making sure the house is being delivered to you as promised. Look for any new dings in the walls or scratches on the floor from the move out. And most importantly, check on those repairs. If the seller agreed to fix that leaky faucet or patch a hole in the wall, you need to see the completed work with your own eyes. If something is wrong, if the air conditioning suddenly isn't working, or you find a giant hole in the wall hidden behind a sofa, you need to call your real estate agent immediately before you go to closing. This is your final point of leverage. Once you sign those papers, that problem becomes your problem. Your agent can negotiate a solution, like having the seller set aside funds from their proceeds to cover the repair. Do not skip the final walkthrough. It's your last line of defense. Okay, walkthrough complete. The house is perfect. Now you head to the title company or attorney's office. What do you need to bring? This is your closing day checklist. First, a valid government-issued photo ID, like your driver's license or passport. They need to verify you are who you say you are. Second, and this is the big one, you will need a cashier's check. Not a personal check. Not a suitcase full of cash. A cashier's check. This is for your down payment and your closing costs. The final amount will be on your closing disclosure, which you received a few days prior. A cashier's check is a check guaranteed by the bank, meaning the funds are certified. To the title company, it's as good as gold. You'll go to your bank, tell them the exact amount you need and who to make it payable to. Your title company will give you these precise instructions, and they will issue the check for you. Some title companies may also accept a wire transfer, but be extremely careful. Wire fraud is a massive, devastating problem in real estate. Always verbally confirm the wiring instructions with the title company over the phone using a number you know is legitimate, not one from an email. Triple check everything. Finally, it's a good idea to bring a copy of your purchase agreement and your final closing disclosure, just for your own reference. You walk into the room, can feel a little intimidating. Who are all these people? Let's break it down. There will be a closing agent, also known as an escrow officer or a settlement agent. In some states, this will be an attorney. This person is a neutral third party. They don't work for you and they don't work for the seller. Their job is to facilitate the transaction, to make sure all the documents are signed correctly, that the money goes to the right places, and that the title to the property is legally transferred to you. Your real estate agent will almost certainly be there, sitting by your side as your advocate and guide. The seller might be there, or they might have pre-signed their documents. Sometimes a representative from the lender is there, but that's less common these days. For the next hour or so, this room is the center of your universe. And then it begins. The closing agent will slide a stack of papers across the table that looks like it's a foot thick. Don't panic. This is the moment you've been preparing for. You're not just signing blindly, you're executing a plan. While there are dozens of documents, they mostly revolve around 3 monumental pillars. Pillar number 1 is the final closing disclosure, or CD. You've already seen a version of this, but this is the final official accounting of your loan. It lists every single cent involved in the transaction. Your job here is to play a quick game of spot the difference. Pull out the loan estimate you received at the very beginning of this process and compare it to this final CD. The numbers should be incredibly close. Your interest rate, your loan amount, your monthly payment, they should match what you were promised. Some costs can change slightly, but others by law cannot. This document is the ultimate proof of the deal you're getting. If you see a major, unexpected fee or a different interest rate, you stop everything and ask why. Pillar number 2 is the promissory note. Of all the things you sign, this is arguably the most important. The promissory note is your promise. It's the IOU to the lender. It's a legally binding document where you state, I promise to pay you back this specific amount of money, at this specific interest rate, over this specific period of time. It lays out the total amount you borrowed, your interest rate, your first and last payment dates, and where you need to send the payments. It also details what happens if you're late on a payment. This document is a direct contract between you and the lender. It is the core of the debt. When you sign this, you are officially taking on the loan. Pillar number 3 is the deed of trust, or in some states, the mortgage. If the promissory note is your promise, the deed of trust is the security for that promise. This is the document that connects your loan to the property itself. It gives the lender a security interest in your new home. In simple terms, it's the document that says, if I break the promise I made in the promissory note and stop making my payments, the lender has the right to take this property back through a process called foreclosure. It sounds scary, but it's a standard and necessary part of every home loan. It's what makes the bank feel secure enough to lend you hundreds of thousands of dollars. The deed of trust is what gets publicly recorded, officially tying you and your lender to that specific piece of real estate. You'll sign and initial other documents too: tax forms, title documents, escrow account agreements. Your hand will start to cramp. You will sign your name more times in 1 hour than you have in the past year. But through it all, remember your power. You have the right to ask questions. If the closing agent is flying through the pages and you don't understand something, stop them. Say, can you explain this page to me in simple terms? It's their job to do so. This is one of the biggest financial decisions of your life. You deserve to understand what you're signing. Once the last page is signed, the final step happens. You hand over that cashier's check. At the same time, behind the scenes, your lender has wired the massive loan amount to the title company. The closing agent confirms all the money is there. This is a moment called funding. They do a quick final calculation, ensuring every penny is accounted for. They pay off the seller's old mortgage. They pay the real estate agent's commissions. They pay the property taxes and recording fees. And then the remaining balance, the seller's profit, is transferred to them. The great financial reshuffling is complete. And then it happens. The moment that makes it all real. The seller or the closing agent will slide something else across the table. It's not a document. It's not a check. It's a set of keys. They feel impossibly heavy in your hand. This small piece of metal represents the culmination of all your hard work. Your saving, your discipline, your stress, your hope. This is the key to your front door. The key to your future. The key to your home. You did it. You shake hands, you might even hug your agent. You walk out of that office blinking in the sunlight, and for the first time, you're not just a prospective buyer or a loan applicant. You are a homeowner. But the story isn't quite over. As you drive to your new home, a few things are happening in the background. The title company is sending the signed deed of trust to the county recorder's office to make it part of the public record, officially and forever stamping your name on the property. And somewhere, a clock has started ticking down to a new milestone. Your very first mortgage payment. That first mortgage payment. It's a strange feeling, isn't it? For months, every dollar was scrutinized, saved, and aimed at a single moment in time. The closing day. Now the dust has settled, the keys are in your hand, and a new financial rhythm begins. This isn't just another bill. It's the first tangible proof that this is real. This is yours. But wait, who do you even pay? You spent all this time building a relationship with your loan officer, with the lender. But chances are, you won't be sending your money to them. This is one of the most common points of confusion for new homeowners. Within a few weeks of closing, you're going to get a very important piece of mail. It's a welcome packet, or a notice of servicing transfer. Your original lender, the one who approved and funded your loan, has likely sold the servicing rights of your loan to another company. This is completely normal. It happens with the majority of mortgages in the United States. Think of it this way: your lender was the architect and builder of your loan. The loan servicer is the property manager. They are the company you'll deal with for the next 15 or 30 years. They collect your payments, manage your escrow account for taxes and insurance, and send you your monthly statements. So when that packet arrives, open it immediately. It will contain your new loan account number and instructions on how to set up your online portal and make that first payment. The single most important thing you can do right now is set up autopay. Don't even think about it. Just do it. Life gets busy, and the last thing you want is a late payment on your brand new mortgage, which can have a serious impact on the credit score you worked so hard to build. With the payment logistics handled, you can finally take a breath. You're standing in your new, probably empty home. The echo of your footsteps is the only sound. It's exciting, but it can also be a little overwhelming. What now? The paperwork is done, but the journey of homeownership has just begun. Let's create a quick first 30 days checklist, the essential first steps to truly making this house your home. Number 1, and do this before you even move the first box in, change the locks. You have no idea who has a key from the previous owners, a neighbor, a contractor, a distant relative. For a small cost, a locksmith can rekey all the exterior doors, giving you complete peace of mind. This is your sanctuary now, secure it. Number 2, transfer the utilities into your name. This should ideally be scheduled to happen on your closing day. We're talking electricity, gas, water, sewer, and trash. And don't forget about internet and cable. The last thing you want is to be sitting on a pile of boxes in the dark with no Wi-Fi. Number 3, update your address. This sounds simple, but it's a cascade of notifications. Start with the big ones. File a change of address with the US Postal Service. Then think about your financial life, your banks, credit card companies, car loans, and your employer for your W-2. Update your driver's license and vehicle registration. And of course, all those online shopping accounts. Number 4, and this is a huge one that people often forget, could save you thousands of dollars. As soon as you're settled, look up your local county's homestead exemption. In many states, if the home you purchased is your primary residence, you can file for this exemption. It effectively reduces the assessed value of your home for tax purposes, which in turn lowers your annual property tax bill. The deadline and rules vary by state and county, so a quick search for homestead exemption, your county name, is your next step. It's a simple form that can translate into significant, recurring savings. Finally, take all those documents from your closing, that mountain of paper you signed, and put them somewhere safe. A fireproof box or a dedicated digital folder. You might need them for your taxes, for a future sale, or if any discrepancies ever arise. Don't just toss them in a drawer. This is the official record of the biggest purchase of your life. Treat it with respect. A month or so will pass, and you'll receive your first official mortgage statement from your new servicer. Let's break down what you're looking at, because it's not just a bill. It's a report card on your investment. You'll see your total payment, but it will be broken down into 4 parts: PITI, principal, interest, taxes, and insurance. The principal is the portion of your payment that actually goes toward paying down your loan balance. It's the part that builds your equity. The interest is the cost of borrowing the money. Here's the tough pill to swallow. For the first several years of your loan, the vast majority of your payment will go toward interest. If you look at an amortization schedule, which shows your payment breakdown over the life of the loan, it looks like a seesaw. In the beginning, interest is way up high and principal is way down low. But with every single payment you make, that seesaw slowly, almost imperceptibly, tilts. The interest portion shrinks, and the principal portion grows. Every dollar you pay is a tiny chisel carving away at that mountain of debt, until, years down the road, your payment is almost pure principal. The T&I, taxes and insurance, are handled by your escrow account. Remember that? Each month, you pay 1/12 of your estimated annual property taxes and homeowner's insurance premium into this special savings account managed by your servicer. When those bills come due, the servicer pays them on your behalf. It's a fantastic system for budgeting. But here's the catch. Property taxes and insurance premiums can, and usually do, go up over time. Once a year, your servicer will conduct an escrow analysis. They'll look at what they paid for your taxes and insurance last year and project what they'll cost next year. If there was a shortfall, meaning your taxes or insurance went up more than expected, your monthly payment will need to increase to cover that shortfall and build the cushion back up for the year ahead. This is why your mortgage payment isn't always fixed, even with a fixed-rate loan. It's a living number, tied to the costs of your local community and the insurance market. Understanding this from day one prevents a nasty surprise down the road. So here you are. You understand the payment, you've secured your home, and you can read your statement. You've officially graduated from home buyer to homeowner. The process you just went through, the pre-approval, the house hunting, the offer, the underwriting, the closing, it was a marathon. It tested your patience, your finances, and your resolve. But look at what you accomplished. You took a dream, an abstract idea of someday, and you forged it into reality. You navigated a complex financial system designed to be intimidating. You signed your name on the dotted line, not as a leap of faith, but as a calculated step toward a future you control. This building of wood and drywall is now a vessel for your life. It's the backdrop for future holidays, for quiet Tuesday nights, for movie marathons and lazy Sunday mornings. It's the place you'll measure your kid's height against a door frame, the garden you'll plant in the spring, the walls that will absorb the sounds of laughter and life. You didn't just buy a house. You bought a piece of your community. You bought a foundation, not just of concrete, but of stability in an unstable world. You built a powerful engine for wealth creation called equity, which will grow silently in the background with every payment you make and every year that passes. This 10-part journey we've been on wasn't just about explaining the steps. It was about demystifying the process, about pulling back the curtain to show you that this monumental achievement is not reserved for the few. It's for you. It's attainable. So take a moment. Stand in your living room. Walk through that front door again, but this time not as a visitor or a prospective buyer. Walk in as the owner. Take a deep breath. Smell the paint. Feel the floor beneath your feet. You did it. You are home. And you earned this.